One large driver of return in the first quarter included the US stimulus package that was passed in March 2021 for $1.9 trillion, in addition to the stimulus plan that was signed into law in December of 2020 for almost $1 trillion. And another big driver has been the expedited COVID-19 vaccine rollout and adoption across the country, in concert with increasing optimism around the reopening of the economy and resumption of consumer spending. In Q1 of this year, the Sustainability Leader strategy continued to have a strong absolute return, but trailed in relative terms. A number of factors helped performance of the strategy in Q1. For just a reminder, in Q4, we added a number of value stocks, which were beneficiaries of the rotation from growth to value in Q1 of 2021 and contributed to our portfolio returns. In addition, we were in an environment of rising interest rates. And so our financial stocks, such as Bank of America and Charles Schwab, both did very well in the quarter. We think Bank of America is also one of the leading banks in terms of their commitments to sustainability, as they term it, responsible growth. A big part of their commitment is disclosure and reporting at all levels, ranging from gender diversity and equality to environmental commitments to support of their communities in which they operate. In Q1, Bank of America announced that they're going to set a goal of net zero greenhouse gas emissions in their financing activities, which is a little unusual, as well as operations and supply chain before 2050. Another contributor in financials was Charles Schwab. And we like Charles Schwab for a number of reasons, but they performed well in the quarter, particularly because of higher interest rates. Specifically, mortgage-backed security yields have rebounded, and that is the majority of Charles Schwab's investment portfolio. Resideo is another industrials company, which we added, provides smart home solutions around comfort, thermal, and security. And at their investor day, they raised targets and shared very positive growth expectations, which helped the stock as well. So what hurt performance in Q1? A few of our solar names that had outperformed in 2020 took a temporary cooling in Q1 2021. Kind of mainly from concerns around rising interest rates, which could indicate potentially higher cost of capital for these growth stocks. So the market reacted on those companies in Q1. However, we do believe that the long-term fundamentals for renewables continue to be attractive, and our solar stocks have raised guidance for 2021. In addition, global commitments to solar and wind continue to grow, and legislative catalysts, such as the pending US Infrastructure and Jobs Package, as well as the proposed Clean Act, which would provide support for material emissions reductions, and Green Act, which would boost tax credits for renewables, storage, and EVs. For the rest of the year, we are continuing to review interesting high sustainability candidates with very strong fundamentals and strong balance sheets and good cash flow generation. We are looking at opportunities across multiple industries, not any one specific sector. We are also positioning or continue to position the portfolio in the core style, as this is an all cap core strategy. So we have added some more value names. We are continuing to look at value, but we also are having a keen eye on very strong growth opportunities. So both defensive and offensive thinking.